Corporate finance practice problem using OneNote. Net present value NPV versus internal rate of return IRR or problem 2. Get ready, it's time to take your chance with corporate finance. Here we are in OneNote. If you have access to OneNote, would like to follow along, you're not required to, but if would like to, we're in the icon left-hand side, practice problems down in the 1228 net present value NPV versus internal rate of return IRR Prob 1 tab. Also note, when using OneNote, look at our immersive reader. Our presentations up top will be mirrored down here in the text area. Same name, same number, having transcripts that can be translated into multiple different languages, either listened to or read in them. Closing the icon up, information up top, calculations on down below. Similar to scenario to what we have seen in prior presentations, we have the initial investment that we're thinking about putting down. That's $120,000 in order to receive future cash flows years out into the future. And the thing to analyze these types of situations will typically be the tool used, the net present value NPV and the internal rate of return IRR, due to the fact that those two calculations take into consideration the time value of money. This scenario can apply to many different business settings, such as putting money down to buy equipment, putting money down to buy inventory, putting money down in a project that's going to be going forward that we expect to have a future return in on it. Note, when we look at the net present value and internal rate of return, they are related. So as you think about these two items, you want to think what the relationship is between them and when it would be appropriate to use each of them. So we have the investment, $120,000 we're thinking about putting down to get money back in the future that we're estimating to be after year 1, $39,000, year 2, $25,000, 3, $38,000, 4, $50,000, and 5, $75,000. We have a discount rate of the 9%. That discount rate could be called in different problems: the required rate of return, the discount rate, the hurdle rate. You could have multiple different names for this rate. That rate is not just the rate of inflation. It's going to include what we expect to be in terms of our gain. So the first calculation we will typically do is a net present value calculation using that rate as the discount rate. The name of the net present value often being deceiving, because we will come up to a bottom line number down here and we'll tend to think that that number represents our gain after we take into consideration, say, time value of money with regards to like inflation. But that's not the case. We're not just talking about inflation here. If this number is even 0, that means we have cleared the 9% required rate of return or discount rate or hurdle rate, and that rate is implied or in the calculation of this calculation. So if it was 0 exactly, we would have gotten our 9% return and may then look into the project, may keep it because we cleared the rate of return. Now, if this is greater than, we come to a result that is greater than 0, then we know we cleared the 9% hurdle rate, but we don't know exactly what the rate is in terms of a percentage. We know we cleared the 9%, and we know that we cleared it by some dollar amount past that, which could be comparable to other projects. We could compare projects that have all cleared this rate. But to know exactly what that is, that would be the internal rate of return that we'll calculate second. So the internal rate of return is the rate at which the flow of payments would then result to be 0. Okay, so let's take a look at this one. We're going to do the net present value. To do this, I would list out in the table our payment years from 0 on down. 0 is going to be our installment, what we're going to put down, the money going out. And then years 1 through 5 are going to be the payments that we're going to hopefully receive. So the 120, that's what we're going to put down in period 0. Period 1, we're going to get the 39,000. We're just mirroring our information up top. 25,000 year 2, 38,000 year 3, 50,000 year 4, and 75,000 in year 5. If we add those up, the 120 minus the positives minus the negatives, in other words, is 107,000. So at the end of the day, after 5 years, not taking into consideration time value of money, we're looking 107,000. Now let's look at the time value of money with the 9% discount rate. I'm going to use the formula, and I would in Excel do the formulas on this first tab, even though it's going to come out to be the same number, because I would like it to be uniform and I'd like to be able to copy it down. If you want to see how that's done in Excel, you could take a look at it in Excel. Note also, you could do these problems with formula calculations or using present value tables, although that would take much longer considering we have uneven payments, no annuities here. So even test questions, it would be kind of not very nice to do that to you, to make you do it with a mathematical formula. But you can look at prior present value calculations in the prior section to see how you can do these present value calculations multiple different ways. Excel would be the preferred way to kind of do this if you're thinking about a net present value calculation with multiple years of different payments typically. So the calculation would look something like this. We would have the present value of the rate. That's going to be the 9%. Notice it's an absolute reference here because when we copy it down, if something's outside the table, I would like to make it absolute so when I copy it down, it does not move that cell. Comma, number of periods, that's going to be the 0. Note that I'm picking up a cell over here and not hard coding the 0 so that when I copy it down, it will pick up the proper period. And we could just copy this down nice and easily if we were doing this in Excel. And then comma, comma, because we're going to the future value, not the payment, because this is a present value of 1, not an annuity. That comes out to 120,000 because we're at period 0. If we do that for the second one, we have the 39,000, similar calculation. We have the rate, still 9%, absolute value. Notice this two cell references the same. Dollar signs represent absolute value. Then we have the number of periods. The number of periods is now 1. That has moved down, is not an absolute value, as you can see. And then comma, comma, and we have the payment or the future value. And that's going to be the 39,000. That moved down, as you can see as well, moved down in the table just as we would expect. If we continue that process on down, we just copy the cell down. 25,000 discounted at 9%, 2 years out, 21,042. 38,000 discounted at 9%, 3 years out, 29,343. 50,000 discounted at 9%, 4 years out, 35,421. And 75,000 discounted 9%, 5 years out, gets us to the 48,745. That then, if we add up this flow, we're at 50,331. Again, be careful because that might lead you to think that we are earning 50,331 as present valued, thinking of this 9% as basically inflation, the cost of inflation, the cost of money being devalued over time. That's not the case. This 9% represents the fact that we have our internal rate of return in there. We have our return included in there. So anything over 0 is something, if this number came out to be anything over 0, we would potentially accept the project. The fact that it's pretty high over 0 at 50,000 is good. The higher over 0, the better. Our next question would be, look, that's clearing the 9% pretty well right there. That looks like a pretty good project. I wonder what my return is on that. I know as a percent, the return is greater than 9%, but I would like to know what my rate of return is. That could be useful if we have multiple projects, for example, that are clearing our discount rate or our rate of return, and we want to pick 1 or 2 of them, and we have to use some discretion. So in other words, we might have enough money to take on any project that clears a 9% rate of return, and in that case, we would take on any project that is greater than 0 when we do this calculation, or we might have to then pick and choose which projects that clear that threshold we want to choose. The higher this number, the better, because that means it does clear this threshold by a higher amount, but I don't know exactly what the rate of return is, and this amount can be deceiving if we were comparing another project that has a different amount of an investment to it. So it's useful to do the required rate of return. So before we do, however, just note that you could also use the NPV formula. I don't see it as useful due to the fact that to use it, you still have to list out your payments in this format. And I would rather just then do my present value calculation so I can see each payment for each period. But present value, the net present value formula would be equals net present value brackets. This would be the rate, which would be the 9%. And then we would have the range. The range is a little tricky because we're not taking into consideration period 0, but just everything after period 0, the 39 through the 75. Plus, you'd have to close it up, then plus the 120,000, which is a negative number. That's the negative amount we would be putting in. That would too get you to the 50,331. So now let's consider the internal rate of return. The internal rate of return, as we said, was the rate at which, it would be the rate at which this net present value calculation would be 0. So in Excel, you can do that quite easily. You could take a look at this 9%. I would put that in a separate cell, this 9%, base my present value calculation on it just as we did before. And then you can think about using trial and error to say, what if I slowly increase this 9% until I get to a bottom line number down here at the end of the calculation at 0? And if you do that, then you'll get to 22%, all the way up to 22% before that is indeed the case. And you can use, of course, goal seek to do that in Excel. So you can ask Excel, would you please change this cell, increase this percent until this net present value is calculated to be 0. And that then would be the internal rate of return, the rate at which this net present value would be 0. So we have a 22% return that we're looking at. That's obviously a lot greater than the 9%, which was our hurdle rate or discount rate or required rate of return. You can also do that IRR with a formula. So you would have to list out your information in this format, listing a negative and all the positives in this format. And then it's a very easy formula, a very useful formula. That would be equals the IRR brackets, and then it's just like the sum function where you take even the negative number all the way down to period 5. So period 0 to period 5, the 120 down to the 75. That too would give you the 22%. Now note that if you use the IRR formula like this, then many people don't understand what it means because they don't have it tied out to the present value calculation. So if you do the internal rate of return formula, I would then prove it to yourself, both so that you understand it better and so you're double checking the calculation by at least plugging it back into the net present value formula. If you did, you expect the net present value to be 0 because the IRR, the internal rate of return, is the rate at which the series of payments would be 0. You could do that with this formula. So I could use the net present value brackets and then pick up the rate, now 22%. Comma, the range would be the 39 through the 75 plus the 120. That would give us a net present value of 0. And we'd say, oh, that makes sense then, because that's the rate that makes this series of payments 0. Or you could plug it back into this table. If you did this internal rate of return first, you calculated the internal rate of return, I would then plug it back into a net present value table just like we did up top, and then do these calculations using this 22%. And you should get, once again, at the end of the calculation, the net present value calculation to be 0. So the basic idea then would be that if you were looking at multiple different projects, you'd probably run the projects through your net present value calculation to see if they clear the hurdle rate. If they clear the hurdle rate like this one, you're going, wow, that cleared the hurdle rate by a lot. That's good. Then you might be comparing multiple projects and you might try to determine which one you should be putting your money into. And the higher this number is, the more likely that that is the better project, but not always, because if you're comparing multiple different projects, you could have very different amounts that you're investing, as well as the cash flows and the time periods. So that could throw off this number being just a straight number, could throw it off. It might be more accurate to have a percent. So then it would be useful then to say, okay, well, I would like to know what my actual return would be to make this cash flow 0 to get my rate of return on a percent basis. That's an internal rate of return, which we would then calculate here. At this case, it would be 22%. That looks pretty good. Tough to beat if my discount rate is 9%. So that looks like a pretty good project. And we can then compare that against other projects and see if another project cleared the 9%, but is lower than the 22%. Say another project had like 15%. Well, then if we could do 2 projects, we might take them both on if we have enough money to put down on it. But if we don't, then we choose the one most likely that has the higher internal rate of return and the one that would most likely probably also have the higher number, the higher amount that cleared the 9%, meaning this is further away from 0, obviously, meaning it cleared the 12% by a further distance. Cleared the 12%, I mean cleared the 9%, whatever the discount rate is. It cleared the 9% by a further distance.